Assalamualaikum warahmatullahi wabarakatuh. Today, our group will be presenting case 4, which focus on ethical issues in financial accounting and reporting. Good day, everyone. My name is Akif Aika bin Kamaruddin, and I am assigned to give an introduction to the case study that our group has conducted. This case involves a construction company known as Apex Builders, and specifically its financial manager, Mr. Ali, who is responsible for making key accounting and financial reporting decisions. Apex Builders owns various assets, including properties, construction vehicles, and heavy machinery used in large-scale construction projects. The main issue in this case relates to the depreciation method applied to newly purchased heavy construction machinery valued at RM 2.5 million. The company currently applies the reducing balance method, which results in higher depreciation expenses in the early years of the asset's life. However, Mr. Ali is considering proposing a change to the straight-line depreciation method. This situation arises during the 2024 year-end financial reporting period, which is a critical time when the company's financial performance is closely scrutinized by investors and lenders. The reason behind this consideration is the increasing competition in the construction industry and the pressure to present higher profitability in order to secure funding for future projects. By adopting the straight line method, depreciation expense would be spread evenly over the asset's useful life, leading to higher report profit in the current financial year. This proposal may present a more favorable financial position to stakeholders. However, it also raises important ethical concerns in accounting practices, which will be discussed further by the next presenter. Thank you.
Thank you, Akif, for the introduction. I am Patin Zulaika, and I will be presenting on ethical issue. So, as we know, the company wanted to change their depreciation method in order to boost profitability. The main intention is to present a higher profit so that the company can secure funding for future projects. However, this action conflict with IAS 16 requirement. According to IAS 16, a depreciation method can only be changed if there is a significant change in the expected pattern of consumption of the asset economic benefit. In this case, there is no evidence that the asset usage or economic benefit have changed, so the change is purely profit driven. Because of this, there are two characteristics that are affected. So first, faithful representation. By changing the depreciation method to increase profit, the company is manipulating earnings and showing bias in their calculation. As a result, the financial statement is no longer reflect the true economic use of the asset and become misleading to the user. Second is comparability. The company profit cannot be fairly compared with previous year because accounting method has changed. In addition, comparison with other companies become unfair, as the profit differences may be caused by accounting treatment rather than the actual performance. So, the next presenter will give a recommendation on how to change the depreciation method in a compliant and acceptable way.
My name is Arif Hafizi Shah bin Azmi, and I will be presenting about the recommendation for Apex Builders. So based on the case analysis, the recommended course of action is that Apex Builders should maintain reducing balance depreciation method for the new machinery, while switching to the straight line method may improve reported profit in the short term. Accounting decision should not be driven by the intention to enhance financial appearance or attract funding. Changes in depreciation methods must be justified by valid operational reasons rather than short-term financial objective. Therefore, instead of adjusting accounting methods to influence profit figures, the company should prioritize faithful representation and transparency when communicating its financial performance to investors and lenders, particularly in relation to long-term project viability. To arrive at this recommendation, 5 key processes were considered to ensure that the decision is technically correct and compliant with the accounting standards. So I will now explain the first 2 processes that support this recommendation, as the other 3 steps of processes will be explained by my friend. So the first process involves evaluating the economic reality of how the machinery is used. So the machinery was purchased for 2.5 million and is being used in a 5-year mega construction project. So in practice, heavy construction machinery is subject to intensive usage during the early years of a project due to a continuous operation. So under the IAS 16, depreciation must reflect the pattern in which an asset's economic benefits are consumed. Based on this usage pattern, the reducing balance method remains the most appropriate and faithful representation of the machinery consumption of economic benefits. The second process involved conducting a quantitative impact analysis to assess the financial effect of the proposed change, which is the depreciation method change. So based on the case information, cost of the machinery is 2.5 million with a residual value of 100,000 and also a useful life of 5 years. So I have done the calculation to differentiate or to compare the two depreciation method, which is the straight line and also the depreciation balance. So under the straight line method, the annual depreciation expense would be 480,000. However, under the current reducing balance method, at 40%, the first year depreciation expense amount would be a 1 million. So as a result, switching to the straight line method would reduce depreciation expense by 520,000 in the current year. So it leads to a significantly higher reported profit. So this clearly demonstrates that the proposed change is not intended to improve accuracy, but rather to artificially inflate the profits, to influence investors and lenders, which raises serious ethical concern.
My name is Bazli Mohammed bin Badoisham, and I will continuing explain the steps in reaching the recommendation. Moving into the third steps of our process, we must look at the identification of ethical threats as outlined in the MIA and IFAC Code of Ethics. It is not enough to just look at the numbers. We must understand the pressures influencing the decision maker. As you can see on the slide, we identified two primary threats. First, the self-interest threat. The finance team is focused on securing project funding, which creates a bias toward showing a better financial picture than reality. Second, the intimidation threat, coming from the increased competition in the construction industry and the management push for high profitability. The critical takeaway here is that by using the calculations we previously discussed to mask the true expense, the department would be violating the fundamental principles of integrity and objectivity. We must remain honest and ensure that external pressures do not override our professional judgment. In step 4, we evaluate the legal and regulatory side through MFRS 108. This standard governs how we handle change in accounting policy and estimates. It is important to note that MFRS 108 only allows a change in a depreciation method if it results in information that is more relevant and reliable. In our case study, Mr. Ali's proposal is not based on a new way the machinery is being used, but rather on the desire for earning management. Our analysis shows that because this change is purely intended to boost reported profit for the current year, it fails the strict regulatory requirements for a change in the accounting estimate. Following through with this proposal would mean Apex Builders is no longer in compliance with Malaysian financial reporting standard. Finally, in step 5, we arrive at our communication and resolution strategy. How do we solve this? We propose a three-part approach. First, management briefing. Mr. Ali must present his findings to the board. He needs to clearly explain the data from step 2 and highlight the legal and reputational risks. If Apex Builders mislead lenders now, they risk the company's future credit rating and credibility. Second, enhance disclosure. Instead of changing the accounting method, Apex Builders recommended using the management commentary section of the annual report. This allows them to explain that while current depreciation is high due to their 2.5 million investment, the future cash flows from this mega project are secure. This provides a true and fair view without manipulating the numbers. The third one is professional refusal. Ultimately, if the pressure continues, the accountants must document the conflict to protect their professional standing. They must comply with the MIA ethical framework to ensure they do not discredit their profession. By following these steps, we ensure that Apex builders remain both ethically sound and financially transparent.
Now, let me explain the conclusion part. Let's go to the key findings. Firstly, under IAS 16, the depreciation method must reflect how the asset is actually used. Heavy construction machinery loses value more rapidly in the early years due to intensive usage. Therefore, the reducing balance method provides a more faithful representation of this depreciation pattern. Next, let's go to the ethical assessment. The proposed change to the straight line method is driven by the intention to increase reported profits rather than improve accuracy. This violates the principle of integrity and objectivity and may mislead stakeholders who rely on truthful financial information. Next, regulatory compliance. The change is not justified under MFRS 108, as it does not improve the relevance or reliability of financial information. Instead, it represents earnings management rather than a valid change in accounting estimate. Finally, the final decision. Apex Builder should maintain the reducing balance method to ensure transparent financial reporting and protect the company's credibility and professional ethics. That's it for my part. Thank you so much.